morning and welcome to Bloomberg Quint, India's first digital live streaming business news service. I'm Neeraj Shah and you're watching Indian Open. Let's go straight to the headlines at this hour. The UK Parliament takes away control from Theresa May on Brexit after the Prime Minister conceded that she does not have enough support. Back home, Jet Airways will use a substantial portion of the 1,500 crore interim funding to get back some of the grounded aircraft. DLF is looking to raise 3,000 crore rupees via a qualified institutional placement offer, 5% discount to the floor price of 193 rupees per share. And the Reserve Bank of India will conduct the first ever long-term forex swap auction today. Top news, British Parliament seizes control of the stalled Brexit process from Prime Minister Theresa May. A series of votes could dramatically alter the course of UK's departure from the European Union. Bloomberg's David Finnerty reports.
And all it actually means is we actually have even more uncertainty. If you put all these outcomes on a probability distribution, every outcome has greater probability. One thing that now has to be factored in is the probability of actually a general election, believe it or not. And that is because Theresa May is obviously losing control without question. So there'll be could be a leadership challenge. But even beyond that, if the indicative votes end up saying we want to kick this can well down the road and maybe have a second referendum, the people in the Conservative Party that are very pro-Brexit, well, are more than likely not going to like that. So there is a danger that the Conservative Party may actually implode. You'll see more and more people go against Theresa May. So there's already signs of that. So that's one outcome that wouldn't be good for sterling. Second is, even if the indicative votes do actually come out with a general consensus, the question then is, will Theresa May decide to go with that consensus? It's not a binding vote. It's just indicative of what they would like. And remember, the EU has to agree. Now, hypothetically, you'd assume that if they did reach a consensus, it would be a milder form of Brexit, which for sterling would be positive, and the can would be kicked down the road. However, the third version, what if there's no consensus? Now, if there's no consensus, really it leaves two options on the table. It really leaves no deal or Theresa May's deal back on the table. Now, ironically, there's a chance that if between those two options, Theresa May's deal may actually be passed, which would be positive for sterling in the sense that it removes uncertainty. But of course, the no deal option there, which would definitely not be good for sterling. So sterling doesn't know which way to go right now. So it's all been manifested in implied volatility. If you look at 3-week implied volatility or 1 month implied volatility, they're already going up. In fact, 3-week, which covers the April 12th election, or vote, I should say, is actually nearly as highest since 2016. Europe doesn't really want a no Brexit either, because obviously it's going to be impacted. The UK is one of its major trading partners, so all the economies in Europe will be impacted negatively to this. So it would be quite happy to kick the can down the road. You would certainly hypothesise, but again, the Europe's going to say, look, we're only going to kick the can down the road if there's really a reason for doing this. If there's no real legitimate reason, if we're just postponing the inevitable, then let's get on with it. But given that the Eurozone economy has its own problems right now, the idea of another adverse shock would not be positive for it, and hence would not be positive for the euro. Hence, we're seeing the euro really going nowhere because, again, it's trying to work out what's going to happen.
Well, so this was one big event that happened. And of course, conversations in the market circles around Brexit is one thing. Conversations in market circles around the inverted yield curve would be the other thing. Speaking of the inverted yield curve, by the way, just a brief mention out here. Janet Yellen at the Credit Suisse conference, and this came in on the website of CNBC. She made comments on the inverted yield curve, saying that in contrast to the times past, there is a tendency now for the yield curve to be very flat. And in fact, it might signal that the Fed would at some point of time need to cut rates. But it certainly does not signal that this is a set of developments that would necessarily cause a recession. So you have a former US Fed chair weighing in on whether this inversion necessarily points towards a recession or it doesn't. And in her mind, it certainly doesn't. She says that because the yield curve is so flat, there might be tendencies for it to actually dip and become inverted at multiple points of time as well, and one should not look at it as an indicator of recession. Well, maybe equity market watchers would really love to hear this. Did this have a bit of an impact on the markets? Maybe not. I mean, not necessarily just Janet Yellen saying, but there's a bit of stability and calmness in the US markets yesterday after the fall that we saw in Friday's session. Ideally, they would have moved up as well, but I think concerns around growth did keep these indices a bit subdued. What about our markets? Well, yesterday was an interesting day because we were down, we were not out, but we were lower by about 1.5% for all the key benchmark indices, including the Nifty Bank. But the selling exhausted, or seem to get exhausted in the second half of trade, or the latter half, the last 1 hour, and the indices in fact recovered mildly at close. The Nifty Bank led this pullback and is likely to be the dominant index in the current expiry week as well. Keep in mind the bounce back in Asian equities could only augur well for our markets in the session today. The SGX Nifty is indicating a flattish start, but look at the Nikkei, Shanghai and some of the others too are showing that there could be some green on the screen, and that should only augur well for our markets. Flows continued, but you would have to say that it raised an eyebrow or two. Now we are used to getting inflows northwards of 1,000 crores. Even if it turns negative, it shouldn't be an issue. But the point is that it was just about 150 crores. So let's wait and watch. The next few days could be very, very interesting. No big impact on the currency, but it's a big day today. This Forex auction swap, the first day, 68.93, a mild bit of pullback in the rupee in trade yesterday. Let's wait and watch what happens today. However, amidst all of this, what are the stocks that one should keep in mind? Well, 4 or 5. Firstly, Jet Airways, and we'll talk about it in detail. But for the uninitiated, the news flow, Naresh Goel stepped down from the chairman and as chairman and from the board as well. And there is an immediate funding support of up to 1,500 crores from lenders. We'll make you hear what the chief lender had to say. But I presume, or rather from what I understand, what I remember yesterday, this number is for a period of 2 months. Jet Airways could be a stock to monitor today. Let's see if it opens lower. QIP opens today for DLF. They're going to sell about 9.69% equity at 183 rupees, 183.4 to be precise per share, to raise about 31,000 odd crores. But that notwithstanding, the point being, it's a number which is lower, so do watch out for this one. Promoters to sell shares in ICICI Pru Life. They are going to sell about 3.73 crore shares at a price of 300 rupees a piece, which is about a 6.8% discount. All insurance companies are coming out and selling their stakes, or select shareholders are selling their stake. The key is, save for SBI Life, the others, when they go down, stay down. Let's see what happens to ICICI Pru over the next few days. In today's session, I wouldn't be surprised if it starts off lower. Prabhat Dairy was down in trade yesterday, but the Competition Commission of India has approved the scheme, and they're going to, the company has said that they are not going to deploy any of the proceeds in the animal nutrition or the cattle feed arms business. I would reckon they should be viewed positively, but let's wait and watch what happens to Prabhat Dairy today. MEP Infra, positive news. Concession agreements, they've got NHAI orders essentially. So concession agreements for 3 Maharashtra highway projects and financial closure for 3 projects worth 1,400 crores achieved. Do watch out for this one. And lastly, Goldman Sachs, they've initiated coverage on HDFC Life. The reason I put it out here, yesterday Morgan Stanley came out with a negative note, a cut in price target. Today Goldman Sachs initiates coverage with a buy rating and a target price of 448. Interesting to see what this stock does. However, lots of stocks, none bigger than Jet, and that's the first piece on First Word today. Sajid Johnson to take us through what Jet Airways plans to do with the 1,500 crores interim funding that comes in from its lenders. I'll just try to weigh in and tell you what it could mean for the aviation space and Jet Airways individually as well, based on what brokerages have said. So that's part one. The US Pharma Watchdog has increased its scrutiny on Indian drug makers, and there are numbers to prove it. Darshan tells us about these numbers. And then Nikki Johnson to take us through the findings of the Bloomberg Quint Cement Dealers Survey. The Jet Airways board last evening approved the resolution plan proposed by its lenders. With Naresh Goel's resignation and the conversion of debt to equity, lenders are now in full control of Jet Airways. Sajid Johnson with the way forward. Sajid, good morning. We got some inkling of the way forward when Rajneesh Kumar spoke to us yesterday immediately after the announcement. Now you've had time to ponder through the details. What happens next? Okay, so what we understand from the lenders yesterday was that, okay, they're taking control of the board and they're going to bring in 1,500 crores in debt backed by security, and that should be good enough till the entire bidding process is over, which Rajneesh said that by May 31st, they should be able to get a bidder and the banks will exit from there. Now, from the operations side, what does it do for Jet? 1,500 crores, Jet is planning to use that to pay off its lessors, creditors and others
who are there. Currently, Jet has roughly around 33 aircraft on ground, which are flying. It plans to take it up to 75% of the original fleet size. Now, in October and December quarter, we had Jet had roughly around 120 odd aircraft. And that came down gradually over the next 2-3 months because of non-payment to lessors and creditors. So the aircrafts got grounded as we speak. Jet says that in the next 3 to 4 weeks, they are expected to ramp it up to at least 65 to 75% of the original fleet size. Now, let's put it in perspective. You have 33 now. You may very well go up to 70, 75. Or more than that aircraft in the next 1 month. So that's additional seat capacity which is coming on in the aviation sector there. Now we've seen prices going up in the last 1 month. Even Delhi Bombay prices touching as much as 50,000-60,000 rupees one way.
Yeah.
I think return.
Return. One way was 25 because I was trying to book.
Yeah. So return, which was there. Now that's going to come off because this will almost add 30-40% of additional capacities in those key sectors. And Jet plans to do exactly that, because when I spoke to the Deputy CEO Amit Agarwal, he said that we're going to submit a summer schedule to the DGCA, which is going to come in for April, May, June, July, and in that we will make sure that we are going to take the aircrafts back, those ones which we will be able to get more utilization out of. Summers are very high peak demand for the aviation sector. It's a peak period for them, and they're going to plan it in such a way that they are going to get higher margins. The big thing which he was very categorical on, that they're not going to go into the discounting game here. They're going to ensure that they get maximum bucks for each seat, so that the cash can be used to to circulate within the for the operation part of it. He also was very categorical on one thing, that 1,500 crores also loosens up other cash which is now stuck with various lenders as bank guarantees or others. So that's additional cash which comes into the system for them, and they are able to use that cash efficiently for going forward. There is an interim management committee which has been formed, which comprises of all the senior management of current Jet, and it will also have some representative of the lenders. The lenders have been advised by McKinsey as far as this entire process is concerned, and they expect this to have the immediate thing would be in the next 1 or 2 days you will see some of the seats getting added in the entire aviation ticketing space. So you will see some immediate effects happening. They are already in touch with lessors and creditors on the issue of taking back those flights or aircrafts, and once that happens, it will be a gradual ramp up which will happen. It will not be immediately 75% of fleet coming back, but it will take 2 to 3 weeks or 4 weeks before that they reach that optimal size.
Okay. Now, before I get to Sajid on what this could mean for lenders as well, let me just try and give you a synopsis of a couple of brokerage notes that have come in. Citi's come in with the note on the space at large, what this means for the aviation space, and Edelweiss Professional Investor Research. I came out with a small note on what this means for Jet Airways as a stock. So keep that in mind. So Citi says that this restructuring could be negative at the margin for Interglobe Aviation, simply because Jet's market share had fallen to 11.4% in the month of February. And from these numbers, as Sajid said, if they take back the fleet, then in about a course of a month's time or thereabouts, the market share of Jet Airways could rise, which therefore at the margin could be negative for both, but they've mentioned Interglobe Aviation quite clearly out here. So that is part one, and I think on that, the popular belief would be that. Now, what kind of an impact it has on numbers, I think we'll get to know only when we get to know. But this is a popular belief, so let's see if that has a bearing on the other aviation stocks. Two, much as people would want to believe that this will be positive for Jet Airways, and certainly from a going concern perspective it is, For a stock price, it will be interesting to see, Sajid, because yesterday the stock went up 12%, and a couple of notes that came in, and more notably the Edelweiss Professional Investor Research note on Jet Airways seems to suggest that, one, the basic that since equity dilution is value negative for investors, they expect some correction in the stock price on open today after the run-up that we've seen. It's also facing some key technical levels to keep in mind. So that's the other thing. So this is on aviation. Wonder what it means for lenders as well. We'll make you hear what SBI chairman had to say yesterday, but wonder what it means for the lenders.
So yesterday Rajesh Kumar was very clear that there isn't any risk to lenders as of now because they have got equity at 1 rupee. So even if they get 2 rupees for the entire equity tomorrow, it's 100% gain for them. But that aside, there's a 1500 crores additional debt which is coming on Jet's book. And Jet claims that they have enough security to provide the lenders for it. They have nearly 16 aircraft which they own. I was told by the management that there is enough headroom there to put those as securities for the lenders, and there are other assets, non-core assets, which can be used as security for the thing. So from a lender's point of view, they may be secure as far as the fresh 1500 crores is there. As far as stock is concerned, Neeraj, even though it is dilutive in nature, it's much better than being almost a shell company, because if you stop
really?
Yeah, so from that point of view it is. So I think that next 2 months the stock will always be supported by the fact that there may be an interested investor coming in. Unless by May end we don't see any movement on that, then you see a different thing, because
the price at which the interested investor comes in would be a key thing as well, right?
See, in an aviation space, there are few things which you need to take care of. One, whether you have aircraft, whether you have lesser agreements, whether you have slots. These are the things which are very difficult to get. Now, look at Vistara. Vistara is not able to expand much because it doesn't have planes or it doesn't have slots. Now, these slots are very important, and there is a value attached to it.
I take on board that point, Sajid. My only question out here to anybody would be that how is it in the current scenario do you assign what is fair value for the stock price of Jet, considering the higher equity base that they have, considering the fact that they have more debt as well, and we do not know what the nature of the restructuring would be. That's the only premise.
So
I think
any investor which
there.
Comes in can, if it's a foreign investor, it can go up to 49%.
Yeah, but the price is the question, right?
The price
which
is
we won't be able to guess right now.
The price is always the question, but that the revival, the market will discount it much before the revival happens.
Okay.
I mean, that's how it is. We saw that happen
usually
in SpiceJet.
Sure.
And the revival happened, it took 2 to 3 quarters for the revival to happen. But the stock factored in a couple of quarters before that.
Okay.
So, so it's a question of whether you believe in the revival or not, whether you believe whether the lenders will be able to turn it around, sell it to investors or not, and who the investors would be.
Yeah, Rajesh Kumar certainly believed in that. We spoke to him yesterday, who assured that the interim support given to Jet Airways is only for a period of 2 months. Listen in.
So time is of essence, because the condition of the company is such a scenario. Lenders would like that they exit this investment as quickly as possible and give the chance to the new investor to revive it. But Jet Airways, lenders believe that it is a great brand, it has great value, and the time which was wasted in ironing out the differences between the promoters, it led to this situation where the Jet is in today. But it can be revived. We are very confident about it. So this is the priority funding which is needed, and this will be sufficient to revive the Jet Airways in our assessment. And this funding is, as I said, just for rather 2 months cushion we have kept. And then once the new investors have formed up their mind, so there will not be much of an issue. The structure of the restructuring of the equity and debt is in such a manner that the facility which is being proposed is fully secured. It will be likely a 10-year instrument, details of which will be made, and it will not be a listed debt instrument. It will be an unlisted debt instrument.
Well, to get a better sense of course, how Jet Airways revival could be carried out, a quick conversation with Jitendra Bhargava, former Executive Director of Air India at 8:30 a.m. today. Let's move on. The next piece on First Word today. Indian pharmaceutical companies have been under increased scrutiny of the US drug regulator of late. The US FDA has taken adverse action against the likes of Lupin, Aurobindo Pharma and Dr. Reddy's labs in the recent past. Does this indicate the re-emergence of regulatory risks in the sector? Darshan is here to talk about that. Morning, Darshan.
Good morning, Neeraj. So interesting stats that came out in this Bank of America Merrill Lynch note. What they did was they compiled the US FDA inspections, what had happened. So in 2018, when across the world the number of inspections were down almost 18%, for India, it was up almost 24%. So the regulatory risk actually for both India and China, we'll focus more on India. A lot of had to do also with the Valsartan issue that happened because of the APIs, I think, and a lot of companies supplied. So the regulatory risk actually went up significantly. And apart from this, if you take a look at India's share as far as the entire global mix of FDA mix is concerned, 2007, it was anywhere between 9 to 12%, 9 to 10% in the last 3 years. In 2017, it was 9%. In 2018, it moved to 14%. And in just till mid-Feb, and BOFA does not count the Lupin inspections that happened, it's 6%. So there is increased regulatory FDA actions that are happening currently. Let's take a look at some of the companies which got negatively affected and some where negative FDA outcome came in. First of all, Alchem Lab, the St. Louis plant, there was negative commentary that was there. It was for a specific product for which the US FDA came in. There were 8 observations and the product approval was denied to Alchem at this point of time. Again, Jubilant Life, 2 negative news that came in. First of all, the warning letter for the Roorkee facility and official action indicated for the Mysore API plant, which a couple of people believe could actually get into a warning letter. Then comes Lupin. So they had a couple of plants, the Mandideep as well as the Somerset facility. They got an official action initiated, and brokerages believe that this could escalate further into a warning letter. 2 of their plants, Goa plant and Indore unit 2, are already under warning letter. So that makes 4 plants of Lupin under the US FDA scanner at this point of time. Dr. Reddy's, the Bachupalli plant, had almost 11 observations and several of them were repeats. We don't know what will happen ahead. The US FDA has not escalated anything, but 11 is a serious observation and accounts for almost 40 to 45% of the US sales. So that's important for them. And for Aurobindo Pharma, nothing negatives come out, but 3 of their plants had observations in the same complex, 1, 9 and 11. Even though the unit 4 got an EIR, the other plants are getting observations, so not all well with the US FDA and Indian plants. Now, a couple of things in which clarity is required, because the inspection happened, but there is no announcement by the US FDA. What will happen to Cipla's Goa plant? What will happen to Glenmark's Goa plant? And what will happen to Bangalore's plant of Biocon? So there is still clarity required. There's no communication for there. But couple of plants in which the key plants are cleared. The smaller plants probably, like Sun Pharma, the Karkhadi plant, as a couple of ex-Ranbaxy plants are under the scanner, but Halol is cleared. Cadila Healthcare's Moraiya plant, which was under the FDA scanner, has been cleared, and Torrent currently does not have any kind of plants under the US FDA scanner. But the likes of it and the announcements, Neeraj, we've seen over the past few days does indicate that the regulatory action by the FDA has actually increased for certain of these Indian companies.
Well, we know what happened the last time that these things happened. One just hopes that not the beleaguered, but the slightly under pressure pharma space and the stocks thereof don't react too negatively to these developments. Darshan, thanks for putting that into perspective. That's Darshan Mehta speaking on the pharma space. And now let's talk about cement as the last piece on First Word. The companies have managed to retain their pricing power this month. A Bloomberg Quint Dealers survey shows that prices rose for the 3rd straight month in March. Nikki Mirchandani is standing by with the survey findings. Nikki, good morning. What are you learning?
Good morning. Steady month yet again for steel companies. In fact, they've gone ahead and taken a price hike of ₹7 per bag, a 50 kg bag for the month of March, marking the 3rd consecutive month of hike. And notably, this comes despite the year-end volume pressures and the holiday-shortened month that we have seen, where labor activity is subdued. And on account of that, the infra activity remains to be muted. If you look at the chart here, you would see for pan-India basis, the prices have been on a steady move. A a 10 rupee hike that we saw, 14 rupee hike that we saw in the month of Feb, which was followed by a 7 rupee hike. So a good run. This is despite the partial rollbacks seen in southern region and more so the major rollbacks that we've seen in north. Now let's look at the south pricing power. Initially, the company tried and hike, went and implemented a hike of rupees 50 rupee per bag hike, a trend which was similar, or the hike which was in similar quantum in the previous month. However, half of it was rolled back on account of muted demand that we saw in Andhra Pradesh and Tamil Nadu. Karnataka pricing power, however, remained pretty much steady. Let's look at the north region, where these players went ahead in the month of March and tried to take a 10 rupee hike, but then that again got rolled back, a 7 rupee cut in fact, and we were left with a price hike of rupees 3 for this region. Next that we have is western region. There the trend is pretty much encouraging because it's the second consecutive month that the region has managed to take a price hike. It was a 10 rupee hike in Feb and a 5 rupee hike followed in March. However, dealers now see a limited scope here on for further price hike, given that the trend has already, kind of heartening for 2 consecutive months in a row for this region. The trend remains pretty much flattish for central and eastern region. Eastern region, if you see the chart out there, that's the steady momentum. Central is the yellow line. The 327 goes up to 335, 340. 340 is the consistent level that we're looking at for central. And if you look at the eastern region there, the prices have remained pretty much steady now for 3 consecutive months. The good part is the pricing power is holding up in eastern region despite the excessive supply that we've seen from Telangana. And for central region, there was a price hike of 10 rupee per bag, but then again, it's holding up steady. So yeah, it's a flattish trend for central and eastern region. However, the trend going forward, Neeraj, we spoke to Sanjay Ladiwala, who is the expert, and he said that the price trend is expected to continue going forward in the month of April and May, essentially because we're seeing a strong demand coming in from rural areas on account of affordable housing segment. On account of that, we expected to see at least 2 more months, good months for cement companies going forward.
Thanks, Nikki. Thanks for putting that into perspective. Well, if MEP Infra or some of the other infra companies and the order inflow that they're getting is an indication, maybe that is supportive as well. Let's wait and watch what happens to prices. For now, this month, they are holding on. That's all that we have on First Word today. Quick programming note. We talk about what happens to individual companies and how you could invest into some of the newsmakers with Rajesh Kothari of AlfAccurate Advisors. Private equity players have turned cautious on investing in real estate projects. But Anuj Puri joins in to speak about how the commercial side of real estate is shaping up. Also in focus is the REITs offerings that have started in India. And then talk about the key growth drivers for Thomas Cook with CEO Mahesh Iyer. But after this break, a full tilt towards the day's trade.
You're watching Indian Open right here on Bloomberg Quint Live. Before we go across and get in a check on what's been happening across Asia, let's tackle the news which is the most important one this morning, and that is of Jet Airways. Jitendra Bhargava, former executive director at Air India, he's joining us on the phone line. Mr. Bhargava, thanks very much for taking out the time. Obviously, this is going to be, a big implication for Jet Airways. They've got the much required funding that they need, but this is going to be more like a short-term infusion for them to get things going for themselves. The bigger game plan, obviously, is to bring in an investor who can actually run the business going forward. What's your take on the entire agreement that has happened post yesterday?
You see, the biggest attribute of yesterday's decisions of Naresh Goyal stepping down, lenders putting in another 1,500 crore rupees, is that Jet Airways has a future now. Whatever pessimism was about its future has vanished, and one is hopeful now that with this infusion, with Naresh Goyal and his wife stepping down, the stumbling block that was there with some of the potential investors has gone away. But questions and challenges will remain, because it's not easy considering the fact that Naresh Goyal delayed the inevitable by a few months, which led to Jet Airways sinking further, with aircraft being grounded, market share diminishing, etc., etc. So there will be a challenge for the banks to put in place a management team that can really pursue the ambitions that the banks have laid out for themselves, and that's not going to be easy. Aviation industry is, as it is, very difficult in India because of price sensitivity of passengers on one hand and the high-cost platform on the other, not allowing full-service carriers particularly to make a reasonable profit in their operations. So having stated this, one will have to look at how do the banks assemble a team, what kind of professionalism they will have, because my take is that Jet Airways will not only need infusion of this 1,500 crore, which will go away in paying the leasing companies for the aircraft which are on ground, the pilots and engineers who haven't been paid for some time. So there is a huge challenge that I visualize for Jet Airways. But I'm optimist, at least on this count, that yes, the southward trajectory on which Jet Airways has been pushed because of lack of decision in the past few months is no longer there, and we will see some kind of optimism, some kind of hope that yes, Jet Airways will be given wings again.
Do you see Jet Airways following the path of what happened with SpiceJet? A new investor coming on board. Obviously, that is the bigger game plan. Getting someone who can run the business operation successfully. I mean,
I will not draw a parallel with SpiceJet. In the case of SpiceJet, you had Ajay Singh as a committed person who took the stakes, and the earlier promoter was equally willing to shed his stake in the airline. Whereas in this case, Naresh Goyal has been allowed to retain up to 25% equity, so which means he, as an investor, he's very much there, and you still do not know whether there is somebody who is willing to take Jet Airways in its existing shape, existing debt level, etc. Because Jet Airways, the big distinction between SpiceJet and Jet Airways is that while SpiceJet was a low-cost airline, Jet Airways is a full-service carrier, and in India, full-service carriers have not been able to command premium on fares, even though they offer additional amenities, unlike in comparison to low-cost airlines. So as long as this compensation is not received by full-service carriers for the additional amenities that they provide, I don't think they'll be able to break even. So as I've very often said, it's the market dynamics that are not allowing full-service carriers to break even. And when you don't break even or recover the cost of producing a seat, you naturally end up accumulating losses, affecting payments to staff, affecting payment to the leasing companies for aircraft, etc. And that's where the big question mark remains.
Right. Mr. Bhargava, we'll leave it at that. Thank you so very much for joining in. Appreciate you taking out the time. Quick thoughts coming in there from Jitendra Bhargava on the way forward for Jet Airways. Bringing in Mayuresh Joshi, fund manager at Angel Broking, who's joining us on the show as well. Mayuresh, good morning to you. We've spoken a lot about Jet, but let's talk about how you expect the stock to react. Because, as per brokerage notes, the equity dilution is going to be value destructive for the current investors.
Morning, Devina. So again, I think what really has transpired for the better part of yesterday and what we probably assume going forward are two parts. So on the fundamental aspect, as the lenders have agreed to probably fund 1,500 crores more, I think the debt levels obviously increase to that extent. The overseas debt is a bigger chunk compared to the domestic debt at this point of time. And what probably happens, as Mr. Bhargava was mentioning, in terms of the operationalities of the airline, the payouts to the pilots, what probably happens in terms of getting those or paying those leases back and getting those aircrafts back. I think the market share of Jet Airways at the end of second quarter was close to 15.3%. That has dropped down drastically, close to 11.3%. So as these services start getting resumed, at best, I think you can probably regain the lost market share that you've got. So to that extent, again, I think the operational capabilities in terms of getting your schedules back, your time logs back, come back to the airline. But the larger picture probably remains, and as you were pointing out, is what kind of an investor actually comes in, at what point he comes in, and what probably happens in terms of the overall dynamics going forward as well. So I think you need a serious investor to probably come and run that airline, because you also need a strategic management change to probably run the day-to-day affairs of this airline as well. So yes, I think from a market perspective, I think the kind of reaction, the trading moves can very well continue. I think for numbers to show, I think you probably need I think, as I said, investor to probably come in with the right amount of cash on its books, so that I think the debt levels probably come back to more saner levels, getting it back to operational capabilities, which is going to take time. And again, I think the outside factors which probably run the industry as a whole, so what happens with crude, the rupee movement, I think these variables are very, very important in terms of the yield that the airline will enjoy and the earnings sensitivity. So yes, trading moves very well possible. Fundamentally, I think it will still take a lot of time for the airline to.
Mayuresh, just quick thoughts. Trading moves on the downside or on the upside? Would you reckon that there could be an immediate downtick today?
There might be, Neeraj, but again, I think the stock might have seen the worst, in my opinion. So whatever you've seen in terms of the lows that the stock had hit over the past few months, I think that is gestating a whole host in terms of the news that Jet Airways has gone through. So yes, I think there might be a short downside tick today, but again, I think it's a range-bound stock till the fundamentals probably improve. But as I said, I think the industry is also going to probably be dependent on a lot of other factors apart from what the airline might be going through in terms of the restructuring.
All right, Edelweiss for one for sure believes that today's session could actually see a downward tick on Jet Airways. Just quickly before I go across to the research team, I want to take a look at the Asian market setup in SGX and how the setup is looking at this current point in time. So Asia is a pocket after yesterday's big sellout in the Nikkei 225, that's recovered 1.8%. Shanghai is flat and Hang Seng trades higher by about 0.5%. SGX Nifty 2 has been trading marginally in the green, just about 10 odd points. That's the cues for the Indian markets as we set up for trade this morning. Quickly going across to our research team then, we've got Mishika as well as Nikki joining in. Lots of stocks and news to keep an eye out on, and both of them will be talking about them. I'll start off with you, Mishika, first on the stocks that you're going to be covering.
Yeah, the first stock that I'm talking about is DLF. The QIP opens today and the company will sell the shares at 183.4 rupees per share. They will raise up to $460 million by selling 9.69% of equity capital. ICICI Prudential Life's promoter to sell 3.73 crore shares in the company, and the floor price has been set at rupees 300 per share, which is at a discount of 6.8% to the current market price. Kalpatru Power Transmission acquires 85% stake in a Swedish EPC company for $24 million. This company deals in power supply solutions and services. UCO Bank's board approves preferential issue of 175 crore shares at rupees 19.01 each to Government of India.
Right, Mishka, thanks very much for that. MEP, Quality, Hindalco, lots of stocks that you're currently.
Yeah, so four stocks precisely. I'm going to start off with MEP, which has received an appointment date for one of its highway project out there, and it's already received financial closure, so this marks the construction period. Pretty much kickstarts the project now, so we're expecting some sort of positive reaction coming in on account of that for MEP. Quality, now this is which is an interesting bit, where the top line performance of the company is 80% down. The company has registered an EBITDA loss of around 1,400 crore, and the net loss is of 1,500 crore. Now, this loss comes at a top line growth, or the top line number, of 300 crore. Notably, the other expenses here have increased by as much as 1,500 crore. That's mainly on account of doubtful debt and advances, which means the sales either have not been recorded earlier properly, or if they've been recorded earlier, they've not been realizing money. So this is one interesting counter that we like to keep an eye out. Quality notably has lost around 90% in the last 1 year, and on YTD basis itself, it's lost 19%. In fact, Devina, in good 2 sessions, the stock has lost around 8 to 9%. So we are expecting some sort of negative reaction coming in on this counter. Hindalco, a sound of caution out there, where the company has faced facing longer EU probe on account of its LRS purchase. With that, the new deadline is around August 8, which is expected to, in a way, hamper the deal, because EU says that the deal may hamper aluminium competition out there in the markets. So essentially, one counter that we can keep an eye out, Aurionpro Solution, where the board has approved a buyback of around 4.5 equity at a price of around 185 per share, aggregating to the worth of around 20 crore.
All right, guys, thanks a lot for that, Mishka, as well as Nikki. So a lot of those stocks that you need to keep an eye out for. Mayuresh, just come in. I mean, we've been talking a whole lot about the steel pocket, particularly over the last few days, and what's been happening with regards to the iron ore prices, with regards to the cheap imports that are coming in from Iran and the implications of that. And now the big elephant, that's ArcelorMittal, that steps into the Indian markets. How does the dynamics of the industry change according to you?
So it's very, very disruptive, Devina, over the past few weeks and months. What has happened in terms of iron ore pricing, for example, I think the volatility thereof largely determines how the operationality of ferrous companies might behave. The second element in terms of cheap imports coming through at this point of time, I think there's obviously a concern on that front as well. The third element obviously is how our domestic demand is expected to shape up. So the large expectations is that domestic demand will probably remain very, very stable and solid. And with that respect, you've probably seen a lot of companies earmark capex either through greenfield projects or the brownfield expansion to probably increase their capacity going forward. Now, what probably happens in terms of steel pricing as a whole, I think the expectations largely depends on the overall global demand-supply dynamics. And from an Indian context per se, I think the demand dynamics look pretty solid compared to what supply we've got. So again, utilization levels expected to remain solid both for flat and long products in terms of pricing. HRC pricing very, very stable at this point of time. The assumptions of input costs being very, very volatile, I think the pass-through does happen with a lag. So I think if input costs do move higher, the pass-through is with a little bit of a lag, which does create a little bit of an upheaval in terms of the EBITDA per ton reported. But largely, again, I think steel companies generally over the next 2 to 3 years, if that is the horizon, I think they should see stable demand come through, stable realizations, and the operating leverage should probably play out with input costs expected to remain stable. So I think the EBITDA per ton for a few of the companies a little bit on the higher side, but considering the macro dynamics, I think ferrous players, specifically the domestic ones, look pretty solid over the next 2 to 3 years.
Do you think that, since the bulk of the demand comes in from the automotive space and the fact that there are some amount of volume pressures that we're facing there, production cuts being taken, that could negatively impact the steel industry and the steel manufacturers and the offtake thereof?
I mean, to a certain extent, yes. And again, I think if you probably look at the other argument that private capex is not picking up, the expectations thereof in terms of how much of an impact does that have in terms of the overall demand dynamics? I think the short-term implications might be true, but as normalization will start happening, and it is not a permanent or a structural change that you are witnessing at this point of time, I think private capex has to resume at some point of time. The government capex again has been front-loaded for the best part of this fiscal. Post-elections, again, I think the kind of expenditure that we probably see on the capital account, on the current account as well, I think that should be reasonable enough to propel the kind of growth that one looks at. Auto, yes, has been through a little bit of a duress and distress over the past few weeks, expected to remain so over the next few weeks and months as well. But again, I think it's the longer cycle that we're talking about. I think steel, ferrous, metal cycles are not to be played over a shorter period. They are volatile because they are ultimately commodity based. But again, I think the demand dynamics for an economy like ours do favor ferrous companies over a longer period of time. And as demand normalizes, I think the volume growth and leverage should come back on their balance sheets.
Mayuresh, quick thoughts on DLF, QIP at a lower price. Would you take advantage of this lower price today?
So again, Neeraj, one really needs to be constructive on the sector as a whole. And for the sector, I think we probably remain far more constructive on companies where the cash flows in terms of new projects being launched, the sales velocity thereof probably looks solid, where the unsold inventory is not too high, where the land bank probably still remains very, very solid. So again, the expansion plan that these companies can embark upon can be far more solid as demand comes back. You've seen new GST rates getting announced, the input tax credit, which is probably being availed by a lot of companies. Again, the kind of leeway that has been given to avail that, which has not been claimed. I think a lot of real estate companies, solid ones, I think, should benefit from that. And the fourth one, again, I think, is going to be less leverage on the balance sheet. So I think companies which probably have this benefit behind them, I think, are going to benefit a lot over the longer period of time. So again, I think, as I've discussed time and again, I think Godrej Properties, Oberoi is something that we hold in our funds, where our belief is that these factors should play out very, very positively over the next 2 to 3 years.
So I'm guessing DLF is not a buy, even after the correction today that we're likely to see.
Not on my list.
Not on your list. Okay, cool. Mahesh, thanks for that. Stay on. Let's get in our technical experts. The about time that we do that. Hadrien Mendonca, Senior Technical Analyst at IIFL, as well as Amit Harchekar, Director at Index Genius Investment Advisors. Gentlemen, both of you, good morning. Always good having you. Thanks much for joining in today. Hadrien, what's your approach to trade today? We are likely to have a flattish start. Would you trade the Nifty or the Nifty Bank in the expiry week?
Yeah, good morning, Neeraj. Yes, definitely. We've seen the Nifty Bank Nifty going through a phase of profit booking in the past two, three trading sessions. I think if you take the retracement of the last 4 weeks rally, that is from the lows of 10,600 to 11,600. I think the 23.6% retracement is coming exactly around the 11,300, 11,330 zone. I would be a buyer and I would actually go ahead and trade the Nifty. I would go long on the Nifty, keeping the stop loss of the 23.6% retracement zone of 11,300, 11,330 zone. And we're expecting a short-term target of 11,440, 11,450. However, with the caveat, if it fails to hold above the 11,300 zone, then I think 11,200, 11,180 zone will also get tested going forward. So I think 11,300 should be a very strict stop loss on your trades.
Amit, what's your approach to trade? The Nifty Bank showed some glimpse of a bounce back yesterday. Heading into expiry, would you be trading that index or the Nifty for that matter?
Well, as I mentioned, that I continue to remain extremely negative on the market for the near term. In fact, right now the market are giving you signals of a long-term sell, and we believe there is a high probability of a decline in this market. Now, if you try to look from the broader angle, the Nifty small cap index has failed to even cross the 23.6% retracement of the entire down move. Plus, if you see the Nifty 200 index, it has formed an expanding triangle that itself is a bearish in nature. And we believe some of the large caps, which have seen a huge amount of run-up, even they are giving you signs of a topping out in the near term. So we believe this market is poised for a major correction. One needs to be extremely cautious at current levels. For Bank Nifty futures, we believe 29,600, 29,700 would act as a supply zone from here on. So 29,700 should be kept as a stop loss on a closing basis. We expect a target of around 28,500 in the coming days. And for Nifty, we are expecting immediate support at around 11,200, and below that we are expecting a target of 11,000. So for a Nifty perspective, we would suggest going short on Nifty futures with a stop of 11,550.
Okay. Those are the index calls that are coming in from Amit as well as Hadrien. Let's take a look at a few stock ideas then. We've got Hadrien's call on BEML, and Hadrien, you're selling Cummins India.
Yeah, absolutely. So BML has actually formed a doji pattern after 2 days of constant fall. And I think it is an early sign that BML might resume its uptrend. So presuming that we'll break the doji's high, we are expecting a short-term target of 985 and keeping a stop loss of 958 on every long positions that would be taken on BEML. The second one is we are slightly bearish on Cummins. We have observed a large bearish engulfing pattern, and the stock is also continuously trading below its 200-day moving average. So I think both these parameters are indicating that further downside can be expected. So one can consider short selling Cummins March futures for a target of 695, keeping a stop loss 732.5.
Okay. Amit, Harchekar, your stock ideas. I believe you've got a call on Reliance Industries, and you're selling ICICI Bank.
Yeah, absolutely. First trade would be buying Reliance 1280 April put options with a stop of 11. Currently the put is trading at around 22. We are expecting it to touch around 60. Now the rationale for same is, if you see Nifty Energy Index, it is trading at an upthrust of rising wedge where we are expecting a 15 to 20% fall. So that should translate into a Reliance prices coming towards 1150 to 1200 in the near term. So we remain quite bearish on Reliance even on a long term basis from here on. Second would be going short on ICICI Bank futures. Here the stop loss would be 396 and we are expecting a short term target of 365. Here the rationale is very similar, as we were discussing that long term charts are indicating sell signals. Clear bearish rising wedge is visible in ICICI Bank, which also projects a downside of more than 20%. So we believe right now some of the large caps are poised for a major decline. For ICICI Bank, the short-term stop loss would be at 396 on a closing basis.
Right. Yesterday's session saw a big sell-off in the Z Group stock. So be it Z Entertainment, Z Learn, Dish TV, all of these counters saw a bashing of sorts. Z was down about 4.5%, Z Learn an equal amount, Dish TV was Z Learn 6.5%, Dish TV was a little bit more, about 5.5 odd percent. What would you do now, Mayuresh, with the group stocks?
So the Z Group stocks?
Yeah.
Yeah, so again, I think the management has made it very, very clear that they have probably started a due diligence process in terms of finding a prospective buyer, and that the buyer should be on the term sheets in the next few months. The lenders obviously have also extended their support till September end. Now, prima facie, as you probably see the numbers for Z, I think the advertising growth, the subscription growth looks pretty solid, the ad growth in particular. Yes, there has been competition in terms of how the subscription revenue has panned out, but a large element in terms of their standalone revenues have been pretty solid. For their OTT platform Z5, the competition is even more intense. But again, I think the kind of marketing spends that they're doing, the kind of capital expenditure that is probably required to get this product stabilizing, I think the kind of expenditure that they are doing, I think the results will be back-ended. So to that bit, again, I think the numbers from their core business and the cash flows thereof are pretty strong. The expectations of a new buyer coming through in the next few months also should probably keep high hopes in terms of the stock. So again, I think I probably retain a positive on the stance and a clear disclaimer. We own this stock in our funds.
You know, the other interesting space could be life insurance, isn't it? Yesterday, MS came out with a downgrade. Today, Goldman Sachs has initiated coverage on HDFC Life with an upgrade, and we will see a large block deal in ICICI Pru at a price of 300. So that stock too will start off lower. These stocks have been in a bit of a cloud, and interesting to see whether or not after these deals happen, they bounce back. HDFC Life hasn't after the deal. Yeah. ICICI Pru may or may not. SBI Life did bounce back after the deal. So a bit of a dichotomy in how these stocks are even trading after a large bulk deal happening in them.
Yeah, and for HDFC Life in particular, I think most of them are focusing on the protection business and how the premium there shapes up and business grows out there, because that's where much of the focus right now is concentrated. Though the last 1 month, the stock has not done a whole lot much, but neither have the others.
Neither have the others. But the question mark out here, Hadrien, Mendonca, if I can come to you, for the life insurance companies, ICICI Pru will start off slightly lower today, arguably will start off lower. Let's assume it starts at 300 because that's the floor price. Would there be a trade in ICICI Pru post that, or any of the other insurance companies post that?
Yeah, so I think SBI Life, according to me, looks the best placed, if you compare it with an SDFC or an ICICI. The stock is looking very stable. It is holding around its 200-day moving average, which is a very good sign. We are seeing good volume participation as well. So I think SBI Life should be the stock that one can bet on because of the stability that SBI Life is providing currently. I think on the upside, if it breaks above the 615, 618 zone, I think we could see a resumption of an uptrend that we saw in the past few weeks. So I think SBI Life should be the preferred bet, among all the others.
Okay. Fundamentally, Mayuresh, would you buy any of the life insurance companies? Would you buy ICICI Pru at 300?
So it's a very, very interesting space, Neeraj, and as we've discussed in the past as well, I think the underpenetration of life insurance itself in India, I think, is a huge opportunity for the listed players. The second element in terms of the maturity of their business over the past few years has probably led to a lot of stability in terms of reported numbers. So when you're now talking about the gross direct premium growth that these companies probably report, when you're talking about the value of new business, when you're probably talking about the value of new business margins as well. So the VNB margins have moved significantly higher, and the expectations in terms of the product mix per se. I think the focus itself of a lot of these life insurance players in terms of the protection business, which is a high margin product, is very well there to ensure that the VNB margins probably sustain at these levels and gradually improve. The fifth element obviously is the kind of subscriber base that they probably add on to. So I think the fixed cost element that a lot of these insurance players have probably taken on board, I think the incremental premiums and the commissions that they probably earn out of that, I think incrementally, I think the revenue quadruples far larger than the cost on their books, which is itself a huge leverage that these companies can enjoy, both in terms of the margin performance as well as the bottom line. So I think there is a strong case for the embedded value to probably improve significantly going forward. A few of the companies within the listed space, I think the product mix needs to be closely monitored. Again, ICICI Pru more dependent on ULIPs at this point of time, but I think you're probably seeing the business mix change. The bank assurance models that they've got also ensures that the distribution of these products happen far more seamlessly. And again, I think the base that they're catering to, obviously with these models, improve going forward as well. So my stack for the life insurance players is SBI, HDFC, ICICI Pru.
Okay, got that. Yesterday's session saw keen interest in the PSU bucket. We're not talking about the PSU banks, but the PSU index as a whole. So on the Nifty, the top 6 stocks were all PSU names. You had Indian Oil, ONGC, Coal India, HPCL, Power Grid, and BPCL stacking up as your top gainers on the index. Remember, we've been talking about a stellar response to the CPSE ETF that had been launched to raise about 3,500 odd crores. Already, by the time we hit Friday end, it had been subscribed almost 6 times. So the response has been stellar. Stocks have been moving. Just quickly get in some chart checks going on any of these PSU names. Amit, Harchekar, Coal India, HPPP, IOC, ONGC, NTPC.
Well, I think the major of up move in whether it's Bharat 22 index or Nifty PSC index is already done. I think that index are up around 10 to 12% from the lows. For stock specific HPCL, we believe the stock has completed its 38% retracement of the entire down move. 285, 290 will remain as a major supply zone. So from a short-term perspective, we would suggest going short on HPCL at around 275. Stop loss would be at around 285 on a closing basis. And since we are expecting this retracement to get over, the short-term target for HPCL is based at around 255 to 260.
Okay, got that. Hadrien, come to you. I mean, while yesterday's session saw keen interest in ONGC, is this a stock that you would like to go long on?
Yeah, so ONGC is actually not doing much. The stock is just consolidating currently. In fact, it is facing resistance around its long-term horizontal line, trend line. So I think that's going to be a very important hurdle of 160 levels. I would be a long buyer on an ONGC only if the levels of 160 is broken. Till then, I think the consolidation phase would continue. Buy only above 160. I think post that we could see a ONGC rallying towards 170, 175 zone.
Okay, got that. Janma, just stay on with us. We've got about 25 seconds left to go for market pre-open. The XGS Nifty is dipped into the red, but it was hardly 10 points higher when we last took a check. So it's given up those 10 points. The rest of Asia, aside from Japan and Hong Kong, China is not doing a whole lot much right now, so that's down about 0.5%. And SGX Nifty, like I said, has lost out those earlier gained 10 points, 11,364. For the Nifty, at pre-open, we're up about closer to 0.2%, but heavy gyrations in the first few ticks that we're seeing. The Sensex is up 0.1% right now. Taking a look at individual stocks, and then you've got your key gainers. First off, Bharti Airtel 2.7% higher, NTPC 1% higher, HCL Tech, India Bulls Housing, ICICI Bank, some of your key gainers. It's the tech stocks that are doing okay. So like I said, HCL Tech, Infosys, not a whole lot bad in today's session. Bajaj Finance, that's up 0.5%. Axis Bank is moved up 0.5%. Titan is up 0.5%. Maruti Suzuki, that's okay. Yes Bank yesterday saw a little bit of a dip, but is up 0.25% this morning. Reliance Industries flat to marginally positive. Amongst the bigger losers, it's UPL, that's down 1%. IndusInd Bank follows suit, down closer to 1%. ITC, Cipla, M&M, Kotak Mahindra Bank. So I think about 9 stocks pre-open, opening in the red. Some marginal moves coming in on the currency as well. Yesterday's close was about 68.93. Currently slightly stronger, 68.88.
Jet Airways, they now wonder what that one is up to. And of course, the other aviation companies should also come up along with it. Well, 10% uptick, don't quite know if it will last or no. And I wonder if Interglobe Aviation or SpiceJet are showing any inklings of a pullback, because City notes seem to suggest that maybe, just maybe, there could be a pullback there. For now, not too much. And 2 other key stocks in news today, actually 3, ICICI Pru, DLF, and then MEP Infra. ICICI Pru and DLF should have some downticks to themselves. Well, closer to 300 maybe for ICICI Pru, closer to 180. No, actually DLF is looking okay. And then the QIP price slightly lower, and then MEP Infra getting large orders. Let's wait and watch what happens there. But early days as yet. Let's wait for these rates to settle down. We'll talk more about them closer to 9:08 and of course talk with our experts about some of these newsmakers. First, let's get in Amit Sarkar, who joins in with the top brokerage calls of the day. Amit, good morning.
Good morning, Neeraj. On the big brokerage calls for the day, first we have is Goldman Sachs on HDFC Life. Now, the brokerage has initiated coverage on the stock with a buy rating and a target price of 488. Now, according to the brokerage, HDFC Life will remain a dominant player in highly profitable and competitive protection segment. Now, the company has a de-risked business model and has an ability to tap into this profitable protection segment, says the brokerage. Now, on the back of this, the brokerage is expecting HDFC Life's VNB, that is the value of new business, to grow at a compounded annual growth rate of 27% over FY19 to FY22 versus a 20% growth rate that it is expecting from its peers over the same time period. Now, it is also expecting the company's margins to expand as it is building its own proprietary business channels and it is broadening its distribution base. Lastly, it says that the premium valuations of HDFC Life would sustain given the strong growth and strong distribution capability of the company. The second, it has initiated a call on SBI Life with a neutral rating and a target price of 639. Now, according to the brokerage, SBI Life's key competitive edge has a key competitive edge in the savings business segment because of its large, profitable and relatively untapped bank distribution channels. And on the back of this and a healthy premium growth, the brokerage is expecting the company's value of new business premium to grow at a CAGR of 17% over FY19 to FY22. However, it still remains neutral on the stock as it believes that the company may face challenges given an undeveloped direct channel, lower income customer base and higher pricing. Now, this would also limit the margin upside for SBI Life, says the brokerage.
Okay, we'll watch out. Life insurance certainly been in focus. Brokerage radar, it's been on the brokerage radar. A number of deals happening out there as well. So, Amit, thanks so much for putting that into perspective. We discussed some of those stocks technically as well as fundamentally. So that conversation has happened. Do watch out for what happens to some of those. Just one quick thought from Mayuresh Joshi before we let him go. And Mayuresh, that would be on Hero MotoCorp. The stock touched fresh 52-week lows yesterday. Yes, there is pain. Is the pain in the price for a Hero Moto?
So the pain might very well persist for two-wheelers, Neeraj, at least for the next few months. Now, if you bifurcate the capacities and who caters to what, I think 75 to 110 cc, I think it's one of the toughest competitive capacities that you probably got. There has been a lot of undercutting by Hero's competitor Bajaj over the past few months in a bid to gain market share. But again, I think the kind of expectations that one really has with product launches, with new models coming through, I think it's very difficult in an environment like this because the inventory level is already very, very high in the system at this point of time. You're probably expected to see more discounting take place to liquidate that inventory. And I think genuine demand to come back is going to take time. With the new ABS regulations coming through, you're also going to see some amount of cost push pressures come through as the prices of these vehicles start moving higher as well. So what probably happens in terms of normalization is going to take time. The rural theme is something which rules Hero MotoCorp specifically. So again, I think the output realizations from a farm crop output perspective, I think is going to be extremely critical. What probably happens in terms of the monsoons, again, is going to be very, very critical in terms of the overall demand dynamics, specifically in the second half. And again, I think, as I said, within the category distributions as well, I think that is the biggest strength of Hero MotoCorp. I think that CC capacity between 7510 and 110, 150, I think the competition is becoming very, very intense. So I think you are going to see these challenges that a lot of these two-wheelers are going to face. So I think the price movement for a lot of these two-wheelers is going to remain subdued, in my opinion, at least over the next few months.
Okay, that's Hero MotoCorp. Maruti has obviously been in focus since a long time now with the kind of pain points that it has been witnessing. The stock's at about 6,500, but a slew of guests that we've been talking to have probably not ruled out the possibility of it going lower to even levels of about 6,200 or lesser. On the charts though, Hadrien, does Maruti look equally weak?
Yeah, absolutely. It's still not out of the woods. If you see the last two sessions, it is making an attempt to stage a recovery, but every kind of move that is coming on the upside is being utilized to short sell further. So I think it's still not out of the woods, and Maruti can further decline towards the 6,300 lows that it hit on in the last week of January. So I think one should consider to remain short in Maruti. 6,300 should be the short-term target.
6,300 on Maruti. Okay, got that. Mayuresh, just one last word before we let you go. Anything in particular, a conviction idea from your end?
So I think I still prefer the financials, Devina, at this point of time. And the thesis still remains same. I think the kind of expectations that one really has in terms of credit growth picking up over the next few months, I think that should substantially aid the overall advances movement for well-capitalized banks. The second element, obviously, is asset quality pressures are seemingly coming off, both in terms of the recognition of the watch list by most of the corporate lenders on their books. At the same time, I think the provisioning that is probably required for NCLT cases, I think is substantially being done. So I think the cost-to-income ratios should start dwindling downwards. The credit costs as a function in terms of the recognition that has probably happened for bad assets over the past few quarters, as that proportion starts coming down because of a large recognition already happened over the past few quarters as well, I think they should also start dwindling downwards. And that should have a very, very positive effect in terms of return ratio. So one might very well argue with the moment that we've probably seen for a few of these private corporate lenders, whether the valuations are justified at this point of time. No doubt they're at the higher end of the range. But any decline, I think, becomes a very good buying opportunity for long-term investors. So I think a staggered way of probably entering these stocks, and again, I think a systematic approach over the next few weeks and months, I think that is the way you can probably enter these stocks and stay invested over the next 2 to 3 years. The impact cost also comes down in case of volatility, and the expectations of earning a high ROI probably still remains extremely high from a risk-reward perspective.
Leave it at that, Mayuresh. Thanks so much for taking the time out and joining us and giving us that perspective. Appreciate your time. Well, as the pre-open rates have settled, we have a bit of green on the screen. The Nifty 50, 21 odd points. The Sensex, 77 odd points. So the start is not looking all that bad. Let's wait and watch what happens during the course of the day. Bring in one of the guests, Rajesh Kothari, Managing Director at AlfAccurate Advisors, joins us on the show. Rajesh, good morning. Thanks much for joining in. We'll get to your investment thesis and what you're doing in your portfolios in just a bit. But the top newsmakers seem to be the lenders to the aviation space and Jet Airways, or Jet Airways and the other aviation stocks themselves. How have you decoded what the yesterday's move and the impact on both aviation as well as the lenders?
Well, I think it is a overall probably a good news for the sector and most importantly for the lenders. And hopefully, let's see, how the lenders further, get their action plan. Probably by 1Q is what they are targeting, and hopefully some solution will come whereby the lenders, whatever the money which has been lent, they get basically money out of it and it doesn't become NPA. So I think what is important is the very interesting the way in which the lenders have approached this entire case, and I think it is going to become I would say a milestone case for any promoters in future as well, to make sure that you pay your dues on time. Otherwise you may probably get such kind of a treatment where promoters may not remain the owners and controllers of the companies which they have nurtured. So I think it is a very important message for corporate India, and I hope that probably lenders will get their dues earlier than what probably they might have thought.
Rajesh, stay on. We're minutes away from market open. Let's tell our viewers all that they need to know to stay ahead in trade today. First up, since we're talking about Jet, lenders take full control of Jet Airways. Founder Naresh Goel steps down, and lenders will pump in 1,500 crores in immediate funding. The aim is to get the grounded aircraft back in the skies.
ICICI Prudential Life to hold offer for sale of 2.6% equity. This offer comes with an oversubscription option to sell another 1.1%. Floor price is set at about 300 rupees per share.
Grasim Industries will be in focus today. The Bombay High Court grants stay against the tax department's demand of 5,872 crores as dividend distribution tax.
DLF looks to issue 17.3 crore shares via qualified institutional placement, which opened yesterday. Floor price for the issue was set at 193 rupees per share.
UCO Bank's board approves preferential issue of 175 crore shares at 19 rupees each. This is against the government's capital infusion of 3,300 crore rupees.
And lastly, Goldman Sachs initiates buy rating on HDFC Life, sets a target price of 488 rupees per share. The brokerage says the company may remain dominant in highly profitable and competitive protection segment.
Well, time will tell. Let's see how all of that goes. Less than 3 minutes left for the markets to kickstart trade. Let's take in some thoughts from our trading thoughts from our technical experts, and then take in the top calls too. Amit, Harchekar, Jet Airways 263, 3.5 for somebody who initiated longs yesterday, carried home the longs, another 3% higher. Would you book profits?
Well, I think this up move could extend towards 275, 280, so that becomes an ideal level for exiting the stock from a short-term basis. Okay,
so that's the verdict on Jet Airways, technicals, fundamentals, all of them put together. ICICI Pru is likely to start off 3% lower. Keep that in mind. And DLF is looking strong. Actually, Hadrien, coming on those real estate names, DLF or Godrej Properties, how are they looking on the charts?
Yeah, Godrej Properties is one of our preferred picks. In fact, if you see the weekly charts, the stock is broken out with huge volumes, and the move in the previous week has been, very, very fast and very, very steep. So I think a little bit of consolidation is needed for Godrej Properties. So, an opportunity would arise around the 780, 800 zone, wherein it would be a very good opportunity to once again enter into Godrej Properties. So I think Godrej Properties should be a stock, not only traders, but even investors who have a horizon of of 6 to 8 months, I think a 20%, 25% upside cannot be ruled out for Godrej Properties from here on.
Okay, that's on Godrej Properties. The other one that's probably gaining some eyeballs because of the last 1 month's move has been Edelweiss. The stock has been up about 33% in the last 1 month. Yesterday's session saw some profit taking, and so did the day before that. Today's session pre-open at least looks pretty okay. It's about 2.5% higher for an Edelweiss at 189. It had gone up all the way to 200. Amit, Harchekar, are you tracking Edelweiss?
I think the stock has formed a near-term top. We expect now the stock to drift lower towards 165, 170 zone. But on the upside, we don't expect it to cross beyond 215.
Okay, let's get in those top calls then. Amit, I'll stick with you.
I would suggest going short on SDFC on a marginal up move. The stop loss would be at around 2,000. We believe the stock has completed a triangle on a long-term basis. And the short-term target, we are expecting it to test 1880.
All right, Hadrien, what about you?
Yeah, I would go long on Bajaj Finance. We have seen a falling channel pattern breakout in a smaller time frame charts yesterday. So keeping a stop loss at 2822, we are expecting a short-term target of 2910 with a disclaimer that we have given a buy for our clients as well.
Okay, fair call. Jaman, thanks so much for joining in today and giving us your thoughts. Really appreciate your time. Here's how the markets are starting off. About 0.25% higher for the Nifty and the Sensex. The Nifty bank flattish in the session. So not quite as dominant as it was yesterday in the late trade on the recovery front. But still, a start in the green, which is not bad after the last 2 days when we ended in the red. The mid caps and the small caps and the market bet was very adverse yesterday. For now, the start is looking strong. The Nifty mid-cap index about 80 points. The small cap space about, well, over 0.5%. So not a bad start, really. The market bet would be positive. The heat map and a complete reversal of what happened in trade yesterday. A lot of green, very little red. Select IT names seem to be taking the stick. So Infi, Tech Mahindra, TCS are amongst the stocks. The HDFC Twins very, very flat too. But otherwise, no losers. What about the gainers? And a bunch of them. IOC, ONGC, Coal India, NTPC. So the PSU flavor continues in the session. Mind you, this might be technical and tactical in nature. But anyways, the PSUs are dominating trade. The non-PSU names include an Indiabulls Housing Finance. There is Eicher Motors, there is Bharti and Z. Yesterday's top loser recovers a little bit of lost ground right now, up about 1%. But aside of that, no noteworthy moves. Just that the PSU stocks are dominating trade again in the session today. So 2 days on a trot, the PSU names have been the center point of the buying interest on the large caps, arguably in the mid-cap space as well. Just a couple of pockets that we need to highlight. Aviation stocks. Jet Airways started off in the green in the pre-open session, still in the green, about 6.5% higher for Jet Airways, so 271 and counting. What about Interglobe Aviation and SpiceJet? Marginally lower, both of them, and that's what the City note seemed to suggest, that what is restructuring for Jet Airways would mean some bit of market share lost, which was gain in the pain point for Jet Airways, and at the margin could be negative for these two. For now, the trade seem to believe that. Let's see if this lasts. Just very quickly, yesterday's top losers, and I mentioned how Z was doing well. What about the other Z group stocks? Dish TV, Z-Learn, etc. Well, not bad. They are trading marginally in the green, which is a sigh of relief for anybody who holds them, because yesterday the stocks were getting clobbered in trade. Devina, what are you spotting?
Well, aside from the ones that you already mentioned, Kalpataru Power does well, about 4% higher. Takes its monthly tally northwards of 22%. Hathway Cables is up 3.5%. It adds up to the weekly total of about 12% for the counter. Dilip Buildcon, last few days have been seeing a little bit of a selling rut. Today's session, at least the opening session, has seen gains of about 3% for the counter. REC and PFC, these were two stocks that were extremely active in yesterday's session. Today's session, you're seeing PFC moving up a bit, but REC losing some steam. Just Dial is the other one, Dredging Co-op, 2.5%, MMTC, 2% on the stock. And we've got MBCC. Again, even in the broader market space, it's more of the PSUs that are looking active. Indiabulls Real Estate is up 1.5%. You've got Persistent Systems that moves up in intraday, in early morning trade. Ashoka Buildcon, Motherson Beverages, some of your regular movers on the upside. Those are the gainers. Amongst the losers, Arcom back down at lower circuit, so another 5% given up. You've got Quality, which is looking extremely weak in the session. Remember, we spoke about their results and the impact of that, the stock's down about 3.5% anyways. It's been giving up a whole lot of steam over the last few days. Vodafone Idea is down marginally, Jubilant Life 2%, ICICI Prudential, HDFC Life, both of these counters. ICICI Prudential is down about 2.5%, and HDFC Life should come up on your screens. That's up closer to 1%. Goldman Sachs report suggesting that there is further upside left to the counter. Now, 794 stocks have advanced, 337 stocks have declined.
Well, interesting start to the trading day. Back in conversation with Rajesh Kothari. Rajesh, I know in the past you stated that you guys look at these profit pools and try to limit your investments there. A bunch of companies which would fit that bill are in the space which have the maximum pain point right now, which is the auto space. Even some auto ancillaries, the likes of Motherson Sumi and some of the others. What are you doing in this space right now? If you, hypothetically, let's work with an assumption that you're getting large swaths of money from your investors right now. Would you be comfortable deploying these sums into a Maruti, into a Motherson Sumi, into a Hero MotoCorp? All of them have pain right now.
You are absolutely right. I think this is one of the sector which basically got one of the, probably I would say, the biggest jolt because of the combination of factors: NBFC crisis, rising crude oil price, rising premium cost, and so on and so forth. Having said that, the profit pool opportunity continues to remain big, and I would say that probably for another next quarter or so, so from April to July, you will continue to see the sector to report disappointing numbers in terms of YY growth comparison. So I think probably sector will revive in terms of the demand growth probably from July, August onwards, and second half is going to be better compared to first half. So what we are doing is that I think it is a opportunity, kind of a buy declines kind of stock. No need to hurry, because that next 3 months are probably not going to be that great. And we continue to have active discussions with in the channel partners, the distributors, to trying to understand that what is actually happening to the underlying demand, because such a demand collapse was a surprise even to OEMs, including two-wheeler as well as four-wheeler players. So I think we are somewhere in that point where there is going to be some pain still probably left over next 3 to 4 months, and use that as an opportunity if you have a 3 to 5 years time horizon.
Okay. Rajesh, just comment on some of these PSU stocks. Is the interest just tactical right now for a short period of time, or do you think that they add value to the portfolio?
I think it is going to be very, very mixed bag as far as PSUs goes. Within PSU, one is of course banking, second is capital goods, third is power, fourth is defense and related such companies. We are not very bullish on a PSU theme in general, and we continue to believe that balance sheets of many PSU companies are under significant stress, or they have deteriorated significantly compared to what we have seen the balance sheet 5 years back. So if you look at the balance sheet of many such PSUs companies who were huge cash rich in 2014, and if you compare that balance sheet as on 2018 and 19, I think there is a significant deterioration in most of these PSU's balance sheet. So I do not see, I think it is more of a bottom-up approach rather than top-down approach. So we are selectively positive on, one or two large public sector banks because there is a significant amount of NPA write-down provisions have already happened. And as corporate India recovers, we believe that the NPA will also reduce, slippages will reduce. The banks are very strong and they are pretty large banks, the banks which I am talking about. And therefore, we are buying very selectively one or two large PSU banks. But apart from that, not a single, otherwise a sub-segment in PSUs which we are positive. Yes, I mean, there is a possibility of a trade because as you rightly mentioned, many of these companies are already witnessed so much decline in last 3-4 years. So you might get a bounce, but I think it is better not to play unless and until you are really very positive for the theme for next 3 to 5 years.
Sure. Just to get in a sense from you at this juncture, would there be a theme which you would follow within the mid-cap space and the small-cap space? Because post the initial euphoria that started off end of February and continued for the first 2 weeks of March, suddenly, there's a drop in interest within the broader market space. What's happened there, and do you see a pickup likely?
Last time also we discussed about this, and I will continue to mention same that what is important to note is not whether a company is mid cap or small cap or large cap, but rather break the company in terms of whether company is large profit, mid profit or small profit. So we strongly prefer to bet on companies where the profit sizes of these companies are large, irrespective of their market cap. So to give you a perspective, in India there are close to about 4,900 listed companies. And out of these 4,900 listed companies, there are only 550 companies in India which have reported more than 100 crores of net profit, just 550 companies. So we continue to focus on this universe of these 550 companies because these are really large companies in terms of size of profit. And it is because of their large size of profit, whenever there is any volatility, whether it is a crude oil volatility, currency volatility, geopolitical volatility, their ability to absorb the downturn is very, very high. So there might be an impact even to these companies whenever there is an economic slowdown or business cycle slowdown, but their ability to absorb that shock is very, very high. Let me give an example. For example, in bearings, a company like Timken, and kindly put a disclaimer because we are holding for for our clients. The market cap might be small because of the SEBI's definition of market cap, but company is not small. It is one of the top 3, or in fact there are only 4 bearing companies which are the large ones, and it's one of the multinational with a very strong technology, giant globally, with a very strong profit size, very strong balance sheet, very strong ROEs, and of course dominant leadership in the industry. So always look at the companies not based on market cap, but identify the companies based on size of profit, the lean balance sheet, and most importantly the earnings growth. And we continue to get such opportunities across sub-segments, whether it is bearings, whether it is a specialty chemicals, whether it is a CRAMS, specialty pharma, whether it is few auto ancillary companies, 1 or 2 staffing services, and all these companies are pretty strong in terms of their business model. Their earnings growth may have been impacted in third quarter because of whatever the reasons, whether it is geopolitical or crude oil or NBFC crisis, but their long-term growth is much more secured in nature. And valuation of many of these companies have corrected due to variety of reasons. Of course, one was the realignment of definitions of market cap, and I think that is providing a good kind of an opportunity for investors like us who have a 3 to 5 years time horizon.
Interesting. Yesterday, a couple of specialty chemical companies nudged the 52-week highs too, and a lot of people talk about this as a multi-year opportunity. Rajesh, do you guys have exposure here? What companies do you like, if you like, and why do you like them, or why do you like this space in general?
I think this specialty chemical nowadays is used as a very, very loose word because I don't know how many specialty chemicals are actually specialty. That's very important to know. In the last 2-3 years, many of these companies have got benefit because of significant shortage in China, and because of that the pricing of finished goods went up significantly. Over next 12 to 18 months, I think a lot of these Chinese capacities are coming back on stream. And more importantly, they are coming on stream with a much larger scale, because whenever any company is doing capex, whether it's greenfield or major brownfield, they will do it for a much larger capacity rather than the existing capacities. So many of these companies which have actually benefited because of the significant increase in finished goods prices during last 2-3 years, many of these Indian companies, it may not remain same in terms of the pricing advantage. So I think the real difference will start emerging from now, probably from here to next 12-18 months, between a commodity chemical company and specialty chemical company. So we continue to focus on companies which are really a hardcore specialty in their value chain, in their product offering, and in their, most importantly, the kind of customers. So for example, there is a company, for example, into CRAMS, which is a specialty chemical kind of a CRAMS, and also agrochemical related CRAMS, and also pharma related CRAMS. So this company has nothing to do with the increase or decrease in China prices. In fact, many of these companies within chemical company also got disadvantage in last 2 years because of their major raw material was from China. So all of a sudden now we have 2 types of companies, company A and company B. The B type of companies are the commodity kind of companies. Their profits went up because pricing went up, 200, 300, 400% increase in prices of the few products. And there is actually segment A, which is really specialty chemical companies, where they got impacted because raw material was not available. All of a sudden now we will see raw material is not only available, but it is available at right prices. And therefore their margins, which were contracted in last 2, 3, 4 years, they will all of a sudden will come back to normalcy, and they'll be probably the biggest beneficiary because they are real hardcore specialty chemical companies. So I again request viewers, whenever you look at any specialty chemical company, make sure there is something real special about it, because many of these companies are actually commodity companies.
Well, excellent explanation, Rajesh. I'm not asking you for a buy or a sell recommendation, but what would these companies be, which are the type A companies, which will benefit because of lower raw material prices and availability in the first place? I repeat, these are not buy or sell recommendations, more knowledge about some of these companies.
Yeah, so say for example, there is a company which is one of the large company into fragrances. They sell their product to the top FMCG companies, consumer companies. Their pricing of the product do not go up by 400%, and also they don't come down by 400%, but their raw material prices went up significantly. So there was no availability of raw material, which impacted their finished goods product, not only supplies, but overall turnover also got impacted. And on the same time, their raw material went up, so their margins came under pressure. So this is one of the, for example, business. Second business is, for example, companies like, which are into specialty CRAMS manufacturing for agrochemical and for pharma, which are buying raw material from China, because those are the API raw materials from China, which went up significantly again, and that resulted into some pain in operating profitability. Those companies are again going to get benefit. And there is a third kind of a categories which has nothing to do with China. They are really specialty chemicals. For example, amines. So China is not a competitor, was not a competitor 4 years back also, not competitor even today. So these are nothing to do with China. They are the amines industry, and the growth, it depends upon the pharmaceutical industry and agrochemical industry. And of course, again, there the raw material went up. Few products raw material went up significantly, and which may not continue. On top of it, currency also impacted their profitability, which also may not continue. So this one-off pain which you have seen in second quarter and third quarter of FY19, they may not remain so as we move forward in 1Q and 2Q, and profit will come back to normalcy. And all these companies which I am talking about, they all are leaders in their respective sectors with a 100 crores kind of plus reported net profit. So they are pretty large with a dominant market share and with a very, very strong balance sheet. So I think these are the companies. So it is more of a bottom-up work, of course, rather than top-down, and opportunity is still there to identify such companies.
All right, we leave it at that, Rajesh. Thanks so very much for joining us this morning and sharing your thoughts with us on the platform. Moving on, the Nifty is up about 0.25% right now. Bank Nifty is supporting it as well, closer to 0.4% higher. We're going to take a very short break on that note, but on the other side of this break, private equity players have turned cautious of investing in Indian real estate projects. We speak to Anuj Puri of Anarock Property Consultants and also talk about the key growth drivers for Thomas Cook with CEO Mr. Mahesh Iyer. back. You're with us right here on Bloomberg Quint Live. Real estate sector has been under pressure for a while now. Unsold inventories are a nightmare for builders. Besides, a glut in the economy caused by demonetization and the GST had thrown the sector off track. But private equity investors have stepped in as white knights over the last few quarters. So what's fueling their confidence in this space, and how effective will the lower GST rate from the 1st of April be? Let's find out all about the sector with Anuj Puri. He's the chairman of Anarock Property Consultants. Anuj, thanks very much for taking out the time. Let's talk about the interest that's coming in from private players, and how big a positive do you see that to be? And also, since we're talking about the new GST from April 1st, the dynamics of how that plays out for the entire sector.
So good morning to you and your viewers. Whilst the residential sector is reeling under huge pressure, the commercial sector, on the other hand, is doing fantastically well. It's relatively a small part of the Indian real estate, because residential is about 85% and commercial is about 15%. But that 15% is doing fantastically well. I mean, if you were to look at 2017 and 18, the supply of office spaces that came up was 58 million square feet, whilst the leasing activity was 72 million square feet. So way ahead of the supply. Last year, 2018 calendar year, we had nearly 40 million square feet. I mean, it was the best ever year that we had seen that got leased. Vacancy is at low. Bangalore is at 6%. Hyderabad is at 7%. There is a huge amount of positive interest coming in from IT, ITES, BFSI, startups. The new thing that has come up, who's taken up a lot of space on lease, is the co-working spaces. So clearly the interest that is coming in from the occupiers is then driving the private equity to come into this space. When we speak about the private equity, 3 or 4 things very interesting that have happened if you analyze 2018. The first is that the deal size has gone almost 2.5x. So in 2015, the ticket size of an office space that was being bought by a private equity was about 48 million square feet. We're not now talking about 128 million square feet for $128 million for one deal. The top 5 deals in the private equity space on office was nearly 50% of the amount invested in 2018. So $4 billion was invested in office space by private equity, and the top 5 deals was nearly 50%. Clearly, the REITs that has been done of Embassy and Blackstone has been very positively accepted by the investors. I mean, it's oversubscribed by 2.5x. So if you look at it from the commercial sector, your demand is ahead of the supply, your leasing activity continues, and for the near future, it seems that there is going to be a lot of more absorption coming in from various sectors. Private equity is coming in, not only international sovereign funds, pension funds, but also insurance funds now getting into this space. And then finally, the REIT that has happened, because that is where the private equity has seen that there is a credible exit of the investments that they are doing in India, and thereby they can make profit.
So as per your report, private equity investors over the years, particularly in 2018, have invested about 69% of the money that's come in has gone into the commercial sector. Foreign equity participation has been on the higher end in 2018, 71% in the commercial sector. Can we assume that real estate now is at the cusp of a big change, where the bigger focus is going to start being the commercial space, and as you pointed out, the demand outstrips the supply, and that's where most of these real estate players are now going to start laying focus?
You're absolutely right. I do think is that there are a number of developers who are wanting to slow down on the residential, but double down on commercial. Because it does appear that the demand will continue to stay strong, the rentals will continue to increase, and clearly the private equity largely coming in from Singapore, Canada, and the US is interested in income yielding assets, which are largely office, retail, warehousing, and logistics. But in those three sectors, office is the biggest part of it. And we do feel is that not only from a development perspective, that the developers will continue to focus perhaps more than residential on the office sector, but equally the private equity who's coming into India is wanting this space. And if you were to look at from a private equity point of view, this is a very stable, perhaps a lot less riskier, where they're buying offices that are completed, that are 100% leased, and it is at an income of say 8% that they are being able to come in and acquire, rather than on the residential where they have to take a huge amount of development risk, land approval, construction risk, and then after that the sale risk. Here they are saying is this is a fully developed office asset, fully leased out. We're very happy with the 8% return per annum that we are going to be able to secure.
Anuj, good morning, Neeraj here. Just wondering, when you're talking about the deal size being higher, is it a factor of pricing moving up as well, or is it a factor of more square feet or larger areas being snapped up and therefore the deal size moves up?
I think it's a very good point, Neeraj. It is a combination of both. It's a combination of pricing moving up and equally the square feet getting much larger. So, previously private equity were looking at buying building in parks. Today, they're looking to buy the full park itself. And that's what has changed, because the confidence that the private equity has been able to demonstrate in the office sector, where there are stable occupiers, every month the rent comes in. Majority of them are international occupiers, largely American, who are outsourcing to India. They get a huge amount of comfort, in a building where there are lots of American or blue chip Indian occupiers. And from their perspective, they're now willing to write larger dollar checks, which I think when they came in looking at this sector in 2010-11, they were a little bit mindful. By 15, they had really got some confidence that this is going to be a good sector. But really 2018, the stark difference in the ability to write a check for a larger transaction was very visible. As I said, Neeraj, it's almost 2.5x of the average size of check which private equity was writing in 2015 versus 2018.
Anuj, what does this mean for the players? I mean, the reason I ask this because the Embassy REIT's IPO brought about a spurt in prices for a lot of these listed players, which had small or large commercial real estate properties ready or under development. Do you reckon more of the larger players will come out with REIT offerings in the next 1 year on the back of what's happened to Embassy REITs? And will that be beneficial to your mind for, in a big way, to these players which will have these offerings? Because I reckon everybody from a DLF to a Prestige Estates to a lot of Bangalore-based players do have large commercial offerings which are rent yielding.
Very interesting point, Neeraj. So I'll answer it in two parts. The first part is, is it going to be a major impact on the Indian real estate? Perhaps not as much. And the reason I say is, Neeraj, is because if you look at the overall real estate, 85% is still residential. In residential, there can't be a REIT done because the yield incomes are about 2%. At 2%, there is nobody who's going to buy a REIT. So 85% of the Indian market really goes away. We're talking really on the 15% of that market. In that 15%, Embassy and Blackstone's portfolio was nearly 33 million square feet. The total that we believe that can be REITed out is about 300 million square feet. So what Embassy and Blackstone has been able to raise, we believe the potential of the Indian REIT market is 10x of that. How does it help the overall market is many of these players who are going to be able to then follow and do the REIT, and I think you're absolutely right, there will be more REITs that will come up on the back of the success of Embassy Blackstone, which was heavily oversubscribed, and the ability that there is nearly 10x of stock available to be REITed out, these developers will then start to bring their leverage down by bringing the REIT into the market, raise the money, bring the leverage down, and that money is going to go to the banks where they'll be able to repay their loans towards real estate, which the banks will then be able to roll it over to other real estate players. And that's where I think is that there may be some benefit that the residential sector may get because of the REIT. As the leverage of these developers go down and the banks get more money from the real estate, their ability to then reinvest back into the real estate, the cycle will start to move.
Anuj, just to follow up on that, obviously, while the potential is 10x, as you said, it is the timing of it. And like you yourself said, the commercial, the market is just about 15-odd%. So highly underpenetrated at this point. What do you see happening first? A big boost for the commercial sector and the big growth numbers that come in, post which the REITs start to play a bigger part? Because obviously, we are nowhere close to some of the other countries where REITs take place in a big way. So what happens first? Does the focus on growth within the commercial pocket happen first, and then the shift to monetizing that via REITs? Or, what you have in your portfolio, just go out with it right now?
So my thought is that, you will see perhaps more REITs coming in first because, there is 300 million square feet of stock available to be REITed out today. Whilst on the development cycle, it takes 3, 4, 5 years for new space to come in. So clearly, I do feel is that you will, in close succession of the success of Embassy, Blackstone, perhaps start to see more REITs coming into the market. Simultaneously, there will be development, but that development cycle, by virtue of just pure construction cycle, takes 3 to 5 years. And prior to that, I feel is you will see a number of other REITs happening. Clearly, it is the first REIT that has happened in India, and I'm delighted that it has done well. It has taken a long time for the first REIT to come in. 2014 was the announcement when the government had made to allow REITs to come in, and 2019, so nearly 5 years later, the first REIT came in. But when you look at the other mature markets, the US or Europe, even in those markets, took 5 to 7 years from the time that the government had made the announcement of the REIT to the first REIT coming in. And soon after the success of the first REIT, there were a number of other REITs that followed. So I do feel is that India is going to follow that suit, where you will have REITs coming in before the development really puts in completed office stock into the kitty.
All right. We leave it at that, Anuj. It was a very interesting conversation with you. Thanks so very much for joining us this morning. Anuj Puri of Anarock Consultants.
Thank you very much.
With a quick perspective on what's been happening in the real estate space. Moving on, Thomas Cook has registered a 20% growth in advanced booking as Indians gear up for the summer vacation. The travel company says the millennials are changing the way India takes a vacation. Thomas Cook has witnessed a 35% surge in bookings for Japan. Newer destinations are most sought after, said Executive Director and CEO Mahesh Iyer in a conversation with Mishika Parak. Listen into that conversation.
So if you look at the last year that ended, which is calendar year CY18, we grew our holidays business by about 17%. This is in terms of value. In terms of volume, we grew about 12%. For the current season, which is the holiday season, the period between April to June of 2019, we are actually seeing a 22% growth in our volumes. And we are seeing about 22-24% growth in terms of value also.
Okay. Also, Thomas Cook has observed a 20% growth in bookings. What has led to this kind of growth, and is this growth sustainable in the near future?
Yeah, if you see actually over the last 2 or 3 years, we've been investing a lot into technology and into our channels through which we distribute our products to the customer. Our penetration has been deeper into the tier 2 and tier 3 markets, where we believe a lot of consumers are now willing to spend money on holiday as a category. It is that category of spends where consumers are no more holding back their purses, and holiday is not being looked upon as a once a year event. People are looking at multiple breaks and maybe 2 or 3 breaks during the year. Clearly that's fueling the demand. Also, spends in terms of people having money in their pockets have been much higher over the last 2 years, courtesy of some of the measures that the government has taken, rural income being slightly higher than what it used to be. So all of this is kind of fueling the demand that we've seen for the holiday, and you know, that is a trend that we have consistently seen over the last 2 years. We see no reason why this demand should not continue, purely because if you look at the macro scenario, India is moving away from being a savings economy to a spending economy. A lot of people are now willing to take credit for travel, which was not the situation about 5 years ago. So clearly the options that are available for people to make that travel happening is far more as compared to be what it used to be in the past. So clearly we are very optimistic and buoyant about the fact that this growth will be sustainable.
Correct. Okay, sir, connecting to this answer, are there any trends that you're observing in the industry currently in India and the industry?
Sure. If you look at from an India perspective, I think a millennial travel is defining how people are going to take holidays. You know, unlike in the past, when you talk about domestic holidays, that's people traveling within the country. You know, the definition of holiday was visiting friends and relatives and probably, you know, taking that religious or pilgrimage tour or kind of thing. Today what's happening is that you have a class of travelers, which is millennials and families, who are looking at more experiences. They don't need to come to a travel agent like Thomas Cook to book an airline ticket or to book a hotel accommodation. What they come to us is for the experiences, and that's what we bring to the table. A 150-year-old brand in this country with a lot of experiences, a lot of knowledge about the market, is able to bring the lot of experiences to them, which is exactly what the customers are looking for. And that trend is witnessed into the growth for our domestic business also. We've been witnessing a close to 40% CAGR into the domestic business over the last 3 years. On the international side, we are seeing more popular destinations coming up. Europe used to be the front runner, still contributes about 50% to the portfolio, but newer geographies like Japan, Eastern Europe, Hungary, Scandinavians, they are the ones which are coming up big time, and people are willing to go out and experiment, and that we believe is a great opportunity for us. The other important trend that's happening is that people are no more compulsively looking at GIT only. What I mean by GIT is the group travel. People are willing to invest in more customized offering for which they are willing to pay a price, because what they want is to pack a little more experience that are different from what they have done in the past. So they may start off their travel journey traveling in a group, but increasingly they are looking at more customized experiences for themselves and their family, which we believe is a great run for the future.
Okay, great, sir. Okay, aviation industry data shows that domestic airline passenger growth has slowed down. Do you see this as a concern?
Not really. Actually, if you see, you know, for a person to travel, there are multiple avenues, airline being one. And I think we should be mindful that if you look at the domestic space, Udan as a scheme that the government launched has actually increased more connecting points. So if you are going to measure connectivity or travel only from the 4 metros or the larger airports in the metros, maybe that may not be the right way to look at it. A lot of people are now taking regional connectivities. And to couple that, you have got train, you've got buses, so people are willing to travel through trains. I mean, we operate a lot of groups into Goa where people are willing to actually travel by train and still take that experience out of Goa. So they may not necessarily be the air travelers, but the short durations or the short hauls are actually traveling through the trains also. So clearly, I think there's enough feeder in terms of logistics and transport available for the customer to undertake their travel. So airline may not be the only defining factor, but yes, it's an important lever, because once you talk about holidays, unless you are taking a flight, people don't really get the pride of saying, I took a great holiday.
Correct. Okay, adding to that question, how do you think the Jet Airways crisis is impacting the industry and your company?
It's too premature for me to comment on Jet Airways. Well, I think there's a lot of things that will emerge over a period of time. Clearly, it's going through some turbulent times, and we've read enough of that in the newspapers. So I don't want to make a specific comment on Jet Airways. But yes, as far as our travelers are concerned, people who are booked with us, we've been reaching out to them and warning them, or rather giving them early signals about what the possible impact would be. So we are guiding them through to other airlines. We are ensuring that they have a comfortable holiday with us, giving them more options. And it's not that Jet Airways has grounded all their aircraft. There are still aircraft that are flying. There are about 40 odd aircraft that are flying as of today. So clearly, wherever we can accommodate our passengers onto the same aircraft, we are putting them on. But yes, we are advising our customers and giving them alternative plans to ensure that they are not put through hardships through this period.
Okay, sir. I would like to ask you, how is your foreign exchange business doing considering the competition from banks?
Well, I think I wouldn't see bank as a competition into the space that we operate. Thomas Cook's foreign exchange license is unique. We don't do commercial transactions. We don't do trade transactions. Our license is restricted to travel-related transactions. So clearly, the 20-odd% growth that I spoke about on the holiday is clearly an uptick for the travel businesses, for the foreign exchange business also, because foreign exchange is a byproduct for every traveler. So when he's going to travel abroad, he's going to need foreign exchange to spend on the shopping, to spend on his eating and everything else. So clearly, to that extent, foreign exchange as a business has been growing at about 10-12%, and we see that trajectory to continue. Another important element of the foreign exchange business is the students market. After a lull for about 3-4 years, we've actually seen the last 24 months where the student market has actually come of age. US market is starting to look up, the UK market is looking up, Canada as a destination is looking up. So clearly there are enough and more markets that are coming up on the student side, and clearly there is an opportunity for us to increase the pace of our growth in those segments. So from our foreign exchange business point of view, I don't really see banks as a competition, because the core competency of a bank is banking services, which is current account and savings account, whereas forex is so embedded into a specialized field that our travel related offerings to the customer allows us to operate in that space very well.
Okay, sir. Also, I'd like to ask you, the average cash conversion cycle in the past for Thomas Cook has been negative compared to competitors. So what do you plan to do to change that in the future?
Sorry, I didn't get that question. What do you mean by cash conversion cycle? Are you talking about the ability of the company to convert cash, foreign exchange cash into rupees?
Generate cash. To generate cash.
The capital employed in the business. No, actually, if you see the last 4 years, we've been actually generating a free cash in excess of 250 crores as a group. In fact, for the period ended 31st of December 2018, our free cash generation was 311 crores. Our net cash on the book, net cash, is about 650 crores. So clearly, our ability to generate a little over 250 crores a year allows us enough capital on the table to not only expand our business, but also to look at acquisition as and when they stand up. And you would have heard about the recent acquisition that we made into this company called DEI, which is very adjacent to the travel, and we are quite excited about that space.
Okay, sir. The DMS business that was acquired in July 2017 has turned profitable in third quarter of FY19. Do you think the profitability will be sustained in the coming quarters?
Oh, of course, yes. We made a strategic move to make that happen. It was not about one tactical shift that we made. It's a more strategic move. We kind of weeded out unprofitable accounts. We took out the cost bases that were untenable to those businesses, and clearly right-sized the organization, brought in lot more productivity measures, and more importantly, acquired new customers who have come back to us. So clearly the business is on a growth path, and we expect the sustainability of the profitability for the years to come.